Jonathan Krinsky is chief market technician with BTIG, joins us now with what the charts are saying. Is that your call, that the charts say we're going to have some kind of pullback?
Hey, Scott. Look, I think, if you think about the structure of the market this year, the S&P peaked in February around 6,100 before the plunge into April. We broke through 6,100, and typically when you break through resistance, you do get a check back to kind of retest that support. And so we do think that's coming, into this August-September period. Again, that would only be a 5% pullback from highs, nothing too substantial, but we think you'll get an opportunity to buy around 6,100.
I mean, the commentary would suggest that it would be a quickly bought dip, right? I mean, almost everybody who comes on says, well, I feel a little cautious, maybe we'll get a pullback, but I'd buy it.
Yeah, I mean, that's always the assumption, is that, support holds, but you have to obviously, see how markets would react into that point. But I think that's your assumption at this point, is that 6,100 would be a viable dip initially.
What leads us to 6,100? Something needs to break down, obviously, to maybe start a broader move lower. What is it?
Well, so you're seeing some signs, some cracks under the surface. It's kind of what we've been seeing all along in this bull market. It's everything X, not everything, but a lot of things X the tech AI trade. So if you look at a lot of the consumer-focused names, whether it's transports or retail or the restaurant stocks. And then I think, on the tech side, a part of the market that's had a great run that I think is starting to look a little vulnerable are the semiconductors. And if you think about the seasonality aspect, we actually think software does well in August relative to semis. Over the last 5 years, software has beaten semis for the last 5. So August tends to favor software over semis. But if you look at the semis, they look a little bit vulnerable to us. Obviously, you have NVIDIA later this month, so that's kind of the key driver there. But a lot of the names under the surface are starting to look a little vulnerable.
I don't know. I mean, Broadcom's been trading well. I hear you, for every on semi, just to pick that out of a hat, or an ASML, for example, there's an NVIDIA, there's a Broadcom. There are other chip names that continue to hold up pretty well. Also, the notion that the AI trade, I almost feel like, why should I even worry about the AI trade? If that stuff breaks down, as long as the AI trade, the hyperscalers don't, then we don't get a bigger pullback.
Yeah, I mean, look, maybe the 2 days we saw Thursday, Friday is all we get. But I think, one of the other things we're looking at are credit spreads. And, over the last 20 years, there's a very high correlation between the ISM employment services component and credit spreads. And obviously we know ISM's employment was the weakest since March, one of the weakest readings in the last 2 years. And so if we think that credit spreads are, about as tight as they can get, they probably have a little bit room to move wider. That also suggests some risk in kind of the cyclical versus defensive trade. So there's a lot of moving parts under the surface. Again, look at some of the transportation stocks. I get it; those haven't mattered for the index given the composition. But I think the final point I'll say is that, and it hasn't been too extreme yet, but the blowout earnings we saw from Meta and Microsoft so far haven't really been we haven't seen buying enthusiasm post the print, right? Those highs were kind of the highs so far. That could change, but I think that's the risk, is that we've kind of got as good as it gets from some of those mega cap earnings, and we just see a little bit of profit taking into the back half of the summer.
I'm interested in what you just said about credit spreads, potentially being too tight. We always worry about them widening as a worry sign. Are you suggesting it's a concern that they're too tight because there's only one way to go from there?
To some extent, it's right. I think the bigger concern would be, to your point, if you had rising equity market and credit spreads widening significantly for several months. That's of course what you had in 2007 ahead of the Great Financial Crisis. So we're not seeing anything like that. I think the tactical shakeout risk is a function of, yes, I think it's a little bit complacent. Again, when you look at the correlation between spreads and employment, as well as the correlation between spreads and that cyclical versus defensives, which, by the way, cyclicals versus defensives are flat over the last 3 days, even as the market's up. So, that correlation suggests spreads probably do have a bit to go on the, to go a bit wider here. And I think, again, it's not that's more consistent with the 6,100 call, not something like 5,500 call, which would be more indicative of something bigger under the surface.